$178 a month. That's what we unlocked just by asking our own bank to reprice before we paid a single discharge fee. No new application, no discharge, just a retention conversation in writing. By the end of this, you'll have a 7-step check to run before you refinance so you know whether to ask your own lender first, stay put, or switch. Most refinance videos jump straight to leaving. We start with a call that costs nothing. Our lender sent a marketing email celebrating a new low variable rate. We opened it expecting our mortgage to get cheaper overnight, the way the headlines made it sound. For a minute, it felt like free money had just arrived in our inbox. Then we opened our own banking app after that new low-rate email. Same balance, same minimum, same rate on the account. Only the advertised number on the website had moved and our repayment line had not budged at all. That was the moment we stopped treating headline rate news as personal finance news. The market looked cheaper. Our mortgage did not get the memo. If you're asking whether you should refinance in 2026, you might be sitting in that same gap right now. We're not mortgage brokers or tax advisors. We write from what we tried, what surprised us, and what we do differently next time. This is the check we run before we ever pay to leave, distinct from a full switch strategy, because the rate you're chasing might already be available at home. When the Reserve Bank shifts the cash rate, lenders adjust their pricing, but not always evenly across every loan on the books. Existing borrowers on older products or legacy package tiers often sit still while the shop window changes for new customers. Commentators call it a loyalty tax. You're not being punished for being a good customer, you're just sitting on an older product while the bank competes hardest for new business. That gap can stay for years unless you ask or unless you leave. So the first question is not which lender is cheapest. It is what rate am I actually paying today, and will my current lender move me if I ask? That one reframe stopped us from shopping billboards before we checked our own account. Money Smart frames switching as a cost-benefit exercise, discharge fees, new fees, and lost benefits on one side, lower interest and better features on the other. The same logic applies to retention repricing, not only to a full refinance. If your lender closes half the gap with one phone call, the bar for paying to leave gets higher. That single insight saved us from churning loans for a dinner plate cashback that looked generous until we did the break-even maths. Refinance when all of this is true after you've tried repricing. A material rate gap remains, break-even is clear, you're not trapped by a fixed break fee, the new loan keeps what you use, and you will hold it long enough to survive any cashback clawback period. We treat about 0.25% or more on a variable owner-occupier loan as material once fees are included. Under that leftover gap after retention, switching rarely pays for the paperwork, the admin time, and the clawback risk sitting underneath the cashback. Do not refinance solely because headlines say rates are falling. The published cash rate target tells you about policy. Your loan contract tells you about your repayment, and those two numbers are allowed to disagree for a long time. So let's run the numbers the way we did: one household, one loan, 3 real paths. These rates are examples only. Your retention offer and competitor quote will differ, and that's fine, the method still holds. Illustrative setup: a $580,000 variable balance, $45,000 sitting in offset, and no fixed break fee hanging over us. Ordinary owner-occupier maths, not a special edge case and not a broker fantasy scenario. Interest is charged on the loan minus the offset. 580,000 minus 45,000 leaves a $535,000 effective base, the number that actually drives monthly interest, not the full loan figure on the statement. Path A is do nothing. Stay at 6.45%. Upfront cost is 0, and so is the improvement. It feels calm until you realize every month of inaction is a quiet bill you never invoiced yourself for. On that $535,000 base, staying costs about $2,875 a month in interest alone. Principal and interest repayments will look different, but this interest line is the cleanest way to compare the 3 paths. Path B is ask your current lender to reprice. In our worked example, retention lands at 6.05%, still the same loan, same offset structure, no discharge fee, and no application paperwork at another bank. At 6.05%, monthly interest drops to about $2,697, Same effective base. No switching friction. That is the retention product most refinance videos skip past and the one we almost skipped too. That's roughly $178 a month versus doing nothing, unlocked by asking, not by leaving. Zero discharge fee, zero valuation appointment, zero clawback string attached. That number is why this video exists and why we treat retention as the first product. Path C is refinance elsewhere at 5.95%. On paper, it's the shiny win. In practice, it brings fees, paperwork, admin time, and cashback fine print that can quietly undo the edge if you leave again too soon. At 5.95%, monthly interest sits around $2,652. Better than Path B, but not by as much as the billboard and the cashback flyers suggest when you first open them. Refinance only saves about $45 a month more than repricing. Versus staying, it's roughly $223. But most of that jump was already captured by Path B before you packed a single discharge form. Path C might net around $1,200 upfront after roughly $1,800 in fees minus a $3,000 cashback. If the clawback rules don't bite later, and if the revert rate after any honeymoon still matches the quote you were sold. Put them side by side. Stay near 2,875, reprice near 2,697, refinance near 2,652. The big leap is asking your own bank, not switching logos. Ask your lender 2 questions in writing. What is my current variable rate and comparison rate on this exact loan? And what is the best retention offer you can apply without changing my loan limit or term? Get both answers in writing before you shop. Screenshot the chat or email. It makes the next broker conversation honest. You're comparing a real retention number to a real competitor quote, not vibes, not a marketing page, and not a rate that only exists for brand new customers. Now for the sober part. A lower sticker rate can still lose once you count break fees, clawback, offset value, package fees, and what happens to your repayment habit the week the minimum drops. This is where the shiny path puts on a nicer jacket. If any portion of your loan is fixed, treat break fees as a line 1 veto until you have a written quote valid on a settlement date. A headline variable cut elsewhere is irrelevant to the fixed tranche until it expires. Break costs can erase a year's worth of savings overnight. Patience to fixed expiry often costs less than breaking early for a shiny variable somewhere else, even when every billboard says the market has moved. Cashback looks like free money until clawback rules apply. If you leave within the honeymoon or minimum tenure window, that small rate edge can evaporate, and the gift turns into a bill you did not budget for. A 0.10% rate improvement on a $580,000 loan saves roughly $48 a month if the full balance is charged. A well-used offset does similar work without switching, without discharge fees, and without clawback risk. Don't trade away a genuine 100% offset for a slightly cheaper sticker rate. Feature parity matters, redraw rules, split loan flexibility, and whether the offset is real or capped all sit inside the honest comparison. Compare comparison rates on the same loan type, principal and interest, owner-occupier, similar loan-to-value band, and include annual package fees plus any offset account fees. The sticker variable alone is incomplete, and it will quietly mislead you. When rates fall, some lenders lower your minimum repayment automatically. That feels like relief, but it can extend your loan term and total interest if you do not keep paying the old amount. The saving vanishes into a longer clock. Refinancing to a lower rate without fixing your payment habit can waste the saving. We'd keep paying the old amount or shorten the term on purpose, so total interest actually falls instead of stretching quietly across more years. Banks assess loans at roughly 3 percentage points above the offered rate under APRA's serviceability buffer. Approval to refinance is not the same as the repayment fitting your real household budget. Serviceability and affordability are different tests. Model break-even, total switching costs divided by monthly saving. Under 12 months is strong. 12 to 18 months is often acceptable on the term you will keep. Over 24 months needs a clear reason beyond the rate on the flyer. If retention closes most of the gap, a leftover difference under about 0.15% rarely justifies discharge on a mid-size loan once time, admin and clawback risk are counted. The leftover has to be boringly obvious. Stay and reprice when your months from fixed expiry. Your offset structure is excellent and competitors charge package fees that eat the spread, or you may move, renovate, or change loan size within 18 months. Switching twice is expensive. So here's the 7-step check we'd actually use before instructing a discharge. Write it down if you can. Run it in order. If an early step fails, stop and fix that before you pay anyone to leave. Step 1. Know your current rate, comparison rate, and monthly repayment from the banking app, not a generic email. Step 2. Ask for a retention, hardship, or pricing review and get the counteroffer in writing before you chase a competitor. Step 3. Compare comparison rates on the same loan type. Step 4. Include annual package fees and offset account fees in the maths, not just the headline variable that looks best on a billboard. Same product shape, same assumptions, honest apples to apples. Step 5. Calculate break-even, switching costs divided by monthly saving. Use Money Smart switching calculator as a second opinion if you want one. Step 6. Read cashback, clawback, and honeymoon revert rates before you treat any cashback as free money in your first-year plan. Step 7. Make the stay or go call. Reprice only often wins when the gap after retention is under about 0.15 to 0.25%. Tonight's action is simple. Open the app, then ask in writing. General information only, not personal advice. Your best path depends on your loan, your fees, your features, and how long you'll keep it, so verify every line with your lender, broker, or a qualified professional before you act. The sequence that worked for us: check the app, ask for retention in writing, model break-even against one serious competitor quote, then switch only if the net saving is boringly obvious. If the maths is borderline, repricing plus keeping the old payment is often the sleep-at-night option. Your future self cares about total interest paid, not which logo sits on the offset account. If this helped you run your own refinance check, subscribe. We put out one of these guides every week.